Market trends and economic indicators. In the fast-paced and ever-evolving world of investment, market trends and economic indicators serve as critical tools that shape financial strategies and investment decisions. Whether you're an individual investor looking to maximize returns or a corporation navigating complex financial landscapes, understanding these factors can be the difference between success and missed opportunities. From inflation rates to interest rate movements, and from global GDP growth to geopolitical risks, mastering the dynamics of the market allows investors to anticipate shifts, mitigate risks, and capitalize on potential gains. Understanding market trends and economic indicators is essential for making informed investment decisions. These indicators help investors predict potential market movements, economic conditions, and investment performance. Key components include: 1. Inflation rates definition, the rate at which the general level of prices for goods and services rises, eroding purchasing power. Impact on investments, bonds. Inflation erodes the real return of fixed income assets like bonds. If inflation rises, the real value of bond interest payments decreases. Stocks, equities can sometimes keep pace with inflation as companies may raise prices to maintain profits. Commodities, assets like gold and real estate often perform well during periods of high inflation as they serve as inflation hedges. 2. Interest rates definition, the cost of borrowing money, typically set by central banks, for example, the Federal Reserve in the US. Impact on investments, bonds. When interest rates rise, bond prices fall, since new bonds offer higher yields. Stocks, higher interest rates can lead to lower stock prices as borrowing costs increase for businesses, reducing profitability. Real estate, higher rates can make mortgages more expensive, potentially reducing demand for property and slowing price growth. Gold, low interest rates can make gold more attractive as a store of value since it does not pay interest. 3. Gross domestic product, GDP, growth definition, the total value of goods and services produced within a country over a specific period. Impact on investments, equities. Positive GDP growth usually correlates with stronger corporate earnings, leading to higher stock prices. Fixed income, bond markets often react to GDP growth, with faster growth potentially leading to higher interest rates. Commodities, strong economic growth drives demand for raw materials, which can boost commodity prices, particularly in industries like energy and metals. 4. Employment data definition, metrics such as the unemployment rate, job creation, and labor market participation. Impact on investments, equities. Strong employment numbers can boost consumer spending and corporate profits, supporting stock markets. Bonds, low unemployment may signal inflationary pressures, leading to higher interest rates and lower bond prices. 5. Consumer confidence definition, a measure of how optimistic or pessimistic consumers are about the economy's future. Impact on investments, equities. High consumer confidence typically correlates with increased spending, which can drive company earnings and stock market performance. Real estate, positive consumer confidence can stimulate demand for housing and increase property prices. 6. Geopolitical risks definition, political events or conflicts, for example, wars, trade disputes, sanctions, that impact the global economy. Impact on investments, oil and commodities. Geopolitical risks often affect energy prices, for example, oil, and raw materials, influencing inflation and global markets. Stocks, uncertainty from political instability can increase market volatility, leading to risk aversion and stock market declines. Safe haven assets, assets like gold, government bonds, and currencies such as the US dollar often see increased demand during geopolitical turmoil. 7. Currency exchange rates definition, the value of one currency relative to another. Impact on investments. Foreign investments, currency fluctuations can affect the returns on international investments. A stronger domestic currency reduces returns on foreign investments when converted back. Multinational corporations, companies with global operations are impacted by exchange rates, as profits from overseas earnings can decrease if the domestic currency strengthens. Understanding these market trends and economic indicators helps investors gauge market conditions, make strategic investment decisions, and manage risk more effectively. In conclusion, staying informed about market trends and key economic indicators is essential for making well-informed investment decisions. These factors not only guide investors through volatile financial environments but also empower them to seize opportunities and mitigate potential risks. As the global economy continues to evolve, those who can adeptly interpret these signals will be better positioned to achieve sustainable growth and long-term success in their investments.